You've probably heard of the 4% rule. It's been repeated so often you think it's an absolute truth. You want to retire? Just save 25 times your annual spending, withdraw 4% per year, and you're good forever. But let me ask you something. Does that sound like a serious plan? Or does it sound like something that's easy to remember, easy to repeat, but maybe not necessarily so true? Going into 2026 with life expectations stretching past 90, market valuations looking uncertain, and inflation sticking around way longer than expected, it's time to take a hard look at whether that rule still holds up, especially if you're planning to retire early. I'm Rob Tatro, Senior Portfolio Manager at the Tatro Wealth Advisory Group and Branch Manager at CG Wealth Management. I've worked with hundreds of Canadian families and business owners, and today we're going to unpack not just why the 4% rule is flawed, but how to build a smarter, more flexible retirement strategy that's grounded in math, not myths. The 4% rule is popular for one big reason. It's simple. You take your annual retirement spending, you multiply it by 25, that's your target nest egg. If you need $40,000 per year, you need $1 million, right? You withdraw 4%, adjust for inflation each year, and the theory says that you should never run out of money. That simplicity made it a cornerstone of the FIRE movement. Financial independence, retire early. Thousands of blogs and podcasts have praised it as the golden ticket to freedom. But that simplicity comes at a price. The rule assumes perfect consistency. The rule assumes that the markets perform like they did in the 20th century. It assumes that inflation behaves predictably and actually comes down quite a bit. It assumes that you'll never deviate from your plan. And it assumes that your expenses grow in a straight, linear line. And perhaps more dangerously, it assumes that the psychological stress of volatility won't impact your decisions. We know that that's just not how human beings behave. Let's talk about the two risks that the 4% rule doesn't handle really well. First off, the sequence of returns risk, otherwise known as market timing risk, and second, longevity risk. So sequence risk is the order in which your returns arrive. If the market crashes early in your retirement and you're drawing income from that portfolio, the losses become more locked in, especially if you're not properly diversified. If you had a 100% equity portfolio and you're drawing down that 4%, well, you could be withdrawing from a smaller base, and those withdrawals can compound the damage. Even if the markets bounce back later, it might be too late. Let me show you two identical portfolios. One earns minus 15%, plus 10%, plus 8% in the first 3 years. The other earns plus 8, plus 10, minus 50. Same average returns, right? But for the retiree withdrawing income, one ends up broke, the other ends up thriving. This is one of the key reasons why we believe it's important to have asset allocation, which matches our clients' needs for income. So if you're drawing down on that portfolio, you have to have a piece of your portfolio that you can sell without crystallizing losses, whether it's fixed income or alternatives. You need some liquidity in that portfolio that you can sell, maintain the capital. Equities are falling, you're not selling those. Equity are rising, you can sell those. Then there's longevity risk. A 65-year-old Canadian today has a decent chance of living into their 90s, either one of them if there's a couple. And if you're retiring at 45, you're looking at 50 years of living expenses, healthcare costs, market cycles, inflation shocks, and also possibly 2, 3, maybe 4 more recessions. Any retirement plan that doesn't account for duration risk, the sheer length of retirement, is gambling. It's not planning, it's gambling. So where did this rule come from? In 1994, William Bengen published a study analyzing U.S. historical stock and bond returns. And he asked, what's the highest inflation-adjusted withdrawal rate a retiree could use without running out of money in 30 years? He found that 4% was the highest rate that survived every 30-year rolling period from 1926 to 1976 using a 50-50 U.S. portfolio. So that's 50% stocks, 50% bonds. Then came the Trinity study in 1998, which mostly validated the findings with slightly different assumptions. But think about that. We're talking about a 30-year window. We're only using US data. We're also assuming a retiree at age 65, and we're also assuming 50% fixed income in a period where bond yields were 5, 6, maybe even 7%. Stock returns had averaged during that period 10, 11%. So in 2025, I can say that most of those conditions don't apply anymore. Canadian retirees face global risks, lower yields on their fixed income, longer lifespans. So if we're still using that 4% rule as gospel, are we applying 1994 math to a 2025 problem? I think we are. So let's get brutally honest for a second here. Most of the people who latch onto this 4% rule, especially in the FIRE community, they're planning to retire way earlier than age 65. They're thinking 45 or 50 or even younger. That's not a 30-year retirement. That's potentially 45, 50 years of drawing down from the same nest egg. So this raises the question, why are we applying a 30-year stress test to a 55-year challenge? Research has shown us that when you stretch the time horizon to 40 or 50 years, the success rate of the 4% rule drops significantly. Now, you could try to fix that by increasing your equity exposure to, say, 80 or 90%, so you load up on stocks, you get way more volatility, you get better return, and that will improve the odds historically, but the trade-off is enormous volatility. So if you're retiring, you're drawing income, and now you have $1 million portfolio that's down 35% in a bear market, so now you're at $650,000. Are you still expected, one, to draw down the same amount, and two, to hold on and not panic? Some people will definitely be able to do that, but most people won't be able to stomach that. The emotional cost of an aggressive portfolio for someone who isn't used to it is just as real as the mathematical benefit. And no rule of thumb accounts for you and your sleep quality. Let's talk about the elephant in the room. The 4% rule is based entirely on US market history. What happens when we apply the same logic globally? This guy, Wade Pafau, analyzed 20 developed countries using market data from 1900 to 2015. And he asked, how many of them could have sustained a 4% withdrawal rate over 30 years? Only 2 passed, the US of A and Canada. Countries like France and Germany, Japan and Australia, their failure rates range from 10 to 60%. That's a massive red flag, right? These are countries that made it into the data set. We're not even talking about places like, Argentina or Russia or Colombia, which are excluded due to economic collapses. So there's a survivorship bias in action. If we only studied the winners, we're blind to the full risk profile, right? Retirement plans need to be stress tested across many environments and not just the most optimistic ones with the most optimistic outcomes. And remember, you can't back test your retirement once you're 90. You've gone through it, you've lived it. So if you followed this channel, we don't just look backwards, we look forward. Today, we're in a very different environment than the ones that supported the original 4% rule. Price to earnings ratios is a valuation metric that uses a 10-year average inflation-adjusted earnings to smooth out fluctuation caused by economic cycle. It measures a multiple of what your stock is trading at relative to its earnings. It's calculated by dividing the current price of the stock by the average of the past 10 years' earnings, and it's adjusted for inflation. The long-term perspective helps investors assess whether a stock market is overvalued or undervalued, especially when compared to historical averages. During the same time, bond yields in today's environment, while slightly better than in the post-COVID lows, are still struggling to keep up with inflation, right? So if you have a 60-40 portfolio and the backbone of the 4% rule, that 40% has lower expected returns on both sides. You get higher inflation, lower returns, right? So your real rate of return is not much, right? With inflation where it's at now. The bottom line is that the 4% rule might work for you. It might absolutely work. But there's also a probability of failure, right? If inflation rates stay high, if stock returns are lower because multiples are higher, or if bond returns stay low for an extended period of time, you might not make it. Plus, if you live longer, if your lifestyle changes, this is exactly why rule of thumbs aren't great if you're planning out your retirement. If you're really trying to plan out your retirement, you should go to speakToRob.com and book your no obligation consultation to know exactly what's happening with your retirement. Not a rule of thumb, not a number that's picked out of the air and you hope to apply it to yourself unilaterally. You're not going to jam a square peg in a round hole here, right? It's your life. It's your retirement. This is where the rule of thumb can turn into a blindfold, right? You're blinded by this 4% and you're just not looking at the picture in front of you, which is all of these variables for your retirement. Let's talk about what I think is the most underrated retirement strategy of all, earning a little bit of income. Now, I know this goes against the very definition of retirement, right? You've retired, you should be able to not work. But here's what I mean. Let's say you have a passion project, a side hustle, a small business, a part-time gig, anything that brings 5, 10, 15 grand per year. Well, you've just bought yourself a huge cushion, right? The income reduces your portfolio withdrawals. It boosts the longevity of your plan. More importantly, it reduces the psychological burden of watching your investments fluctuate. It creates cash flow, whether through part-time teaching, dog walking, whatever. If you can earn 10, 15 grand a year doing something you enjoy, right? And it keeps you sharp and you love doing it. Well, that's like an extra 400 grand in your portfolio using that 4% rule. And that can be real power. And don't forget the non-financial side, the structure, the purpose, the engagement. You work on your terms. It could be a powerful contributor to well-being. I've seen it in my clients. So let's wrap this up. The 4% rule was never meant to be a guarantee. It was a useful starting point in the 1990s based on very specific historical data. But your retirement, it's not 1994, right? That's gone. You live in a world of rising lifespans, volatile markets, which have always existed, global risk, personal uncertainty, inflation that's been pretty sticky, and the plan that you build needs to reflect that. So here's what I want you to take away today. 4% rule might not work for you. It might be too optimistic for early retirees. 2, you need to have some flexibility in that plan, right? You need to have someone actually build the plan for you, not just pick a number out of the air and say, we need this 4% thing. No, you need to have a plan that takes into account your taxes, your liquidity needs, your risk tolerance, because your portfolio is not going to be the same as a guy in Saskatoon or the guy in Halifax. You're going to be different. You might have a corporation, personal assets, non-registered, TFSAs. Those are different accounts, different purposes, different needs, and they all act differently, right? Once you've got this plan in place, then you can have the confidence in knowing that you have that information, you have that peace of mind. But randomly picking a number out of the air, I don't advise that. And at the Tatro Group, this is exactly what we do for our clients. We build customized, tax-efficient, adaptive retirement income plans that fit your goals and your lifestyles. So if you want help building a better roadmap for your future, head over to speaktorod.com, book a discovery call with our team. It's no obligations. Also, if you haven't already, make sure to check out our retirement planning masterclass. The link is right in the description of this video. It's packed with even more depth on topics like tax efficiency, portfolio structure, retirement income timing, income splitting, and much more. It's completely free. It's designed specifically for Canadians planning to retire or in retirement, and it's for them to retire with confidence. If you found this video helpful, give it a like, subscribe, share it with someone who's thinking about their retirement. You might also want to check out this video right here. I'll see you there. Thanks for watching, guys. I'll see you in the next video.